This is Optimal Finance Daily, episode 2372. Honey, I forgot to deduct the mortgage interest by Laura Adams with GoodFinancialSense.com. And I'm your host and personal finance enthusiast, Diana Merriam. This is another Monday Mastery episode here on Optimal Finance Daily, where each Monday we take a look at an article that features a more complex personal finance topic. So with that, let's get right to our next article as we optimize your life. Honey, I forgot to deduct the mortgage interest by Laura Adams with GoodFinancialSense.com. As the host of the Money Girl podcast, one of the most common questions I get from show listeners is about claiming the mortgage interest tax deduction, like this one from Alice. Quote, if my husband and I forgot to take tax deductions for the past couple of years for our mortgage interest, what can we do? Is there a statute where you must use it or lose it? End quote. What is the mortgage interest tax deduction? If you're not familiar with the mortgage interest deduction, it's a great tax benefit for homeowners because it allows you to deduct the amount of mortgage interest you pay from your taxable income. If you're a typical homeowner, you're probably paying big bucks for your mortgage each year. So this tax deduction can save you a chunk of change by substantially lowering your tax liability. Who can claim the mortgage interest tax deduction? Not every homeowner is eligible to take the mortgage interest tax deduction. My first response to Alice's question is to make sure that she and her husband are eligible to claim it. Here are the two major hurdles you have to jump over in order to take advantage of the mortgage interest deduction. Rule number 1, you must have secured debt on a qualified home in which you have an ownership interest. Rule number 2, you must file your federal income taxes using Form 1040 and itemized deductions on Schedule A. What is secured debt? The first rule has two parts that I'll define: secured debt and qualified home. According to the IRS, secured debt is one in which you sign an instrument, like a mortgage, deed of trust, or a land contract, that makes your ownership in a qualified home security for payment of the debt, provides that your home could be sold to satisfy the debt, and is recorded under applicable state or local law. In other words, your home must be on the line as collateral if you don't pay the mortgage. In general, the only time a mortgage might not be secured is if you have a wraparound mortgage, purchase with owner financing, or borrow funds to buy a home from a friend or relative. Can you deduct interest on a mortgage refinance? There are two types of debt that qualify for the mortgage interest tax deduction: acquisition debt and equity debt. Acquisition debt is any secured loan you get to buy, build, or remodel your main or second home. It includes refinance debt up to the amount of your old mortgage balance just before doing the refinance. The total amount of interest you can deduct for acquisition debt is limited to $1 million for your main and secondary home, or $500,000 if you're married filing separately. Can you deduct interest on a home equity loan? Equity debt, as I mentioned, also qualifies for the mortgage interest deduction. Equity debt is any loan secured by your main or second home that you took out for a reason other than to buy, build, or remodel. It could be money you spent to start a business, pay for education, or take a vacation, for instance. It has a much lower limit than acquisition debt for claiming the interest deduction, $100,000 or $50,000 if you're married filing separately. What is a qualified home? Now, let's discuss the definition of a qualified home in the context of the mortgage interest deduction. According to the IRS, a qualified home can be your main home and a second home. Either property can be a single-family residence, condo, cooperative, mobile home, trailer, timeshare arrangement, or even a boat, as long as they have sleeping, cooking, and toilet facilities. If you're married and file a joint tax return, your qualified home or homes can be owned by just one spouse or owned jointly. If you're married and file separate returns, you can each claim the mortgage interest for one qualified home only, unless you consent in writing that one spouse can claim the deduction for both homes. So assuming that Alice does indeed have secured debt on a qualified home, she must also comply with the second IRS rule for claiming the mortgage interest deduction, which is itemizing deductions on Schedule A. What are itemized deductions? Itemized deductions are eligible expenses that you can report on your federal tax return to decrease your taxable income. You have the choice each year to claim either a standard deduction for your tax filing status or to add up all your actual deductions and claim them on Schedule A of Form 1040. For example, if Alice and her husband file taxes jointly, their standard deduction for 2011 is $11,600. If they have more than $11,600 in total deductions to itemize, they come out ahead by itemizing as compared to taking the standard deduction. Since most homeowners pay a boatload of mortgage interest each year, it's likely that Alice's family is no exception and would have plenty of deductions to make itemizing worthwhile. How to claim a forgotten mortgage interest deduction. So what should Alice do if she and her spouse were eligible for several years' worth of mortgage interest deductions, but they slipped up and didn't claim them? That could mean they overpaid taxes for years. Anytime you discover an error on your tax return that's due to your income, tax deductions, tax credits, or tax filing status, you should amend it using Form 1040X. You must file a separate Form 1040X for each year you amend, and it must be a paper form because the IRS doesn't allow amended returns to be filed electronically. Also, remember your state tax liability may change if you amend your federal return. Generally, to claim a tax refund, you must file Form 1040X within 3 years from the date of your original return or within 2 years from the date you paid the tax, whichever is later. That means Alice can probably amend her returns for the last 3 years and reclaim her precious but forgotten tax breaks. You just listened to the post titled, "Honey, I Forgot to Deduct the Mortgage Interest" by Laura Adams with GoodFinancialSense.com. Did you know that even if you have health insurance, you could still be overpaying for your prescription medications? Before you fill your next prescription, just checking GoodRx may help you beat your copay price. GoodRx is the fast and free way to save up to 80% on the price of your prescriptions. All you need to do is search for your medication on the GoodRx website or app and show your discount at the pharmacy counter. It's that easy. Not to mention, GoodRx doesn't just work for new prescriptions. It can help you save big on all your refills too. You know how much frugality means to me and how many ways I try to save, but never before have I seen a way to save on prescriptions. I've really loved GoodRx. It's extremely easy even for the older members of my family that I've recommended it to. So for simple, smart savings on your prescriptions, check GoodRx. Go to goodrx.com/OFD. That's goodrx.com/OFD. goodrx.com/OFD. This article demonstrates why I love working with my CPA. I don't have to worry about remembering all the deductions I'm entitled to because he is all over it. Since I bought an inexpensive home well below my means, I'm not paying a boatload in mortgage interest, and the effect this deduction has on my overall return is nominal. However, in talking to various people about how they work with a CPA and/or tax preparer, it's come to my attention that the level of service I get from my CPA is rare. I get 2 meetings per year, one in November for end-of-year strategic tax planning, and one in the first quarter, usually in February or March, to review my return. I try to get him all of my files to prepare my return in February. I then text him throughout the year with any questions. My CPA actually walks me through my entire return, explains everything to me, and answers all of my questions. And then he sends me everything after that meeting to sign so that he can file the return. Apparently, most people never review their taxes with their CPA or tax preparer. If that's you, I'd encourage you to get more curious. By having a full understanding of my tax situation, I'm in a better position to work with my CPA strategically to lower my lifetime tax burden. We talk so much on this show about optimizing expenses and increasing income as a way to grow your wealth in the gap. But sometimes keeping more of the money you already have through optimizing on taxes is worth the time and effort, especially because in my experience, working with a CPA is extremely cost-effective. But that'll do it for another edition of Optimal Finance Daily. Thanks for being here today and every day and making another episode possible. And be sure to come back tomorrow for more, where your optimal life awaits.